Hello there, and welcome to Homeschooling Adventures. My name is Paddington Jerauni, and in today's video, we are going to be looking at the concept of balance of payment. Now, all private businesses, they do maintain a certain set of financial accounts, which they use as a record or which they use to try and review on the business operations to check whether they have made a profit or a loss. Whilst this is true for private businesses, it is also equally true even for countries. Countries, they also maintain a unique set of accounts that helps them to review on all their financial transactions with the rest of the world over a period of 1 year. And in this particular video, we are going to be looking at those accounts as balance of payment accounts. Okay? Now, what is a balance of payment? Someone might be asking. Now, balance of payment is a systematic record or a systematic review of recording or a systematic way of recording financial transactions between one country and the rest of the world. In other words, if we are South Africa, then how we traded with the rest of the world. It could be through exports when we send goods to them, or through imports when we bring the goods into our country. Now, when we talk about exports, learners, I will just explain what exports are. Exports are goods that are made in South Africa and that are going to be consumed by the rest of the world. In other words, that are going to be used by other countries that are not South Africa. Okay? And then we also have imports. When we say imports in economics, we are talking about goods that are made from outside the country, that are made by the rest of the world, and they are going to be consumed in South Africa. Okay, so those are imports. Now, when we talk about the balance of payment, learners, what we need to understand is it is divided generally into 4 accounts under balance of payment. We have the first one that we are going to look at, which is our current account. Now, a current account, it is an account that records the monetary value of exports that we made, that particularly referring to merchandise as well as gold. So our current account, it records exports on merchandise, and when we talk of merchandise, we are talking of goods, okay, merchandise, and also on gold, okay. So the exports that we have made on merchandise and gold, they are also included in our current account. Now, we need to note that gold, though it is a product, it is included in the current account because of 2 reasons. One, it is used also as money on the international monetary system. We also use gold as money on the international monetary system. And then the second reason, you would also understand that gold is included in the current account because it is important to the South African economy. And so because of that, we will now need to also include it in our current account. Now, a current account, it also includes service receipts as well as payments that are made for services. So our current account, we said it also includes service receipts. Okay, so our current account also includes service receipts. Okay, now when we talk about service receipts, we are saying these are receipts that we have received from the rest of the world, or these are monies that we have received from the rest of the world when we rendered a service, when we gave them a service. Okay, we also don't only record receipts, we also even record payments, okay, for the services. So our current account is going to also record service receipts as well as our payments. When, for example, a tourist, an outbound tourist who leaves South Africa going to other countries, okay, when they go to those countries, they are going to be paying for the expenses that side, so for the services that they are getting that side. So that's a service payment. Okay, for outbound tourists, that becomes an example of a service payment. And a service receipt is when the tourists come from other countries, for example, tourists coming from Australia into South Africa, okay, to spend a holiday in South Africa, then the amount of money that they are going to pay to us is what we call the service receipts. Because we are going to be receiving the amount of money from those tourists as we offer them a service. Now, what we need to understand is when it is a payment, because we are saying it's us who are spending, it means the payments are supposed to be subtracted. Okay, whilst our receipts, they will be added in our current account. So we are saying payments, they will be subtracted. Okay, we will subtract the payments in our current account, and then our receipts, we are going to add them in our current account. Okay, so when we are recording now in our current account, our payments, they are going to be subtracted, and then our receipts are going to be added. Okay, these are either payments for merchandise or payments for services. They will be subtracted. Then the receipts from merchandise, from self-merchandise, or even receipts from services, they are going to be added. Okay, now our current account, you would also find that our current account, it also includes the payments and the receipts that are an indication of the amount that was earned by citizens, whilst income, okay, payments shows the amount that was earned by non-citizens who are working in our country. Okay, you understand? So what we are saying is our current account lenders, it's also going to include even the income receipts and the income payments. Okay, now our receipts, it is an indication of the amount of money that was earned by our citizens, okay, who are abroad. Okay, it's a receipt. The amount of money that was earned by our citizens who are abroad. Okay, whilst our income payments, it is going to show the amount of money that was earned by non-citizens who are working in our country, South Africa. Okay, so you would also need to understand that. And then you would also need to understand that when income is earned by workers, okay, when income is earned by workers, if, for example, we have examples like salaries and wages, okay, and then we also have some income that is going to be earned when people invest. Okay, we also have that kind of income that is earned when people invest, which is income that is earned from investment. And that income that is earned from investment, it forms classes like, or groups like dividends that have been paid, or the profits that have been paid. Okay, now whether it's earned by us, okay, for working as workers, or earned by non-citizens, or it was earned by investors, we are still going to be treating it in that way. Now, which would mean now that if a South African has an investment outside the country, the income that they are going to earn there, it is either a dividend or a profit, it is still a service receipt. If it is a non-citizen who is working in the country, and then they have received also some amount of income that they have earned, then it's also going to be a payment, okay? Or even the investment through the direct investments, okay? We are going to look at that. Even investments like direct investments into our country, they are also going to be making even part of our service payments, okay? Right. And then you do now also need to understand that the last item that is recorded in our current account is the current transfers. Okay, now our current account, it also records the current transfers. Okay, now when we talk about current transfers, learners, what we are talking about is we are saying these are this is the income that is transferred from one person without the actual exchange of tangible items. For example, we are looking at things like donations to charity. We are also looking at things like taxes that we pay when taxes are deducted from our salaries. Okay, like taxes, okay, or even donations to charity. Okay, they form part of our current transfers. Okay, so these are the components or the individual elements that are looked at when we look at our current account. So what are they? We said we look at exports on merchandise and gold, and then we also look at service receipts or payments. We also look at the current transfers. And remember what we said? We said payments, they are going to be subtracted, whether it's payments on merchandise or payments on receipts, on services. And then receipts are also going to be added, whether it's receipts from the sale of merchandise or receipts from services. They are also going to be added. Okay. Now remember, our current transfers, it refers to the money or goods and services that is transferred from one institution without any tangible item that was received in return. In other words, it's a money that was transferred from one institution without any tangible goods or services that was received for that payment that you have made or that transfer that you have made. And those things, they are referred to as current transfers. Now you would also now need to understand that we have the second account that we have, which we are going to call the financial. The second one is the financial account. Okay? Now, the financial account, it is an account that records all transactions that involve assets and liabilities. Okay? And then it covers things like we are going to look at the things that it covers. It covers things like one, the foreign direct, or I would just say direct investments. It covers the direct investments. Okay, an example of direct investments, we are looking at maybe things like FDIs. Okay, the foreign direct investment. Now, when we talk about direct investment, we are saying, or foreign direct investment, this is where a new or an existing business are bought by an investor with the sole purpose of gaining control over the business. Now it's very, very important for learners to understand this. We are saying when we talk about direct investment, this is when a business or a new business or an existing business is taken over by an investor, and the purpose of that business being taken over is by the investor to gain a sole control or over the business, or to gain control over the business. Which means if there is any investment that we are going to receive as a country where the investor has an intention of gaining control over the business, then we are saying that is referred to as our direct investment. Are we together there? And then another second one that we are looking at under financial accounts, it also covers things like portfolio investments. Portfolio investments. Okay? Now, when we talk of portfolio investments, what we are talking about there, learners, is we are saying this is when an investor, okay, invests in an existing business, okay, with the intention of gaining a portion of the profits from that business. In other words, here the intention was to gain control on direct investment. But with portfolio investment, the intention is to gain from profits of that particular business. Profits of that particular business. Are we together there? And when that happens, then we are saying it's a portfolio investment. In other words, a portfolio investor has no intention of gaining control on how the business is run. Okay? But their only goal there is to make profits, okay, from that particular operation of the business. Are we together there? Okay, now normally our portfolio investment is referred to as hot money. Portfolio investment, it forms what we call hot money. Portfolio investment, it is hot money. Okay, and why are we saying it's hot money? It's something that you are going to look at the later stages of your studies. Okay, and then the last component of our financial account is what is called other investments. Other investments. Investments. Okay, now other investments, this is where we are going to record all other financial transactions like loans or even things like deposits, short-term deposits that are not considered to be direct investment, or that are not considered also to be forming part of the portfolio investment. So anything else like loans or anything else that is invested, which is not a portfolio investment or a direct investment, is going to be recorded as other investments. Now, this is what you need to understand. In economics, the term investment, it means a purchase of capital goods or shares with the purpose of gaining a share of the profits. If you have a purpose of buying either shares or investing with the intention of getting a share of the profits, then we refer to that as an investment. Now, when recording these transactions, it must be noted that the investments are shown as a net amount. Now, you need to understand that when we are recording these transactions, our investment is going to be recorded as the net amount. Okay, now with the last component that we also need to note there is we have something that is called unrecorded transactions. Okay, which is our third. So we said financial transactions is the second one. Okay, maybe let me just change my numbering here. Okay, this one, direct investment, is going to be A, and portfolio becomes B, and then other becomes our C. So these are subsections of our financial account. Okay, and then the third component of our balance of payment is what is called the unrecorded transactions. Okay, now our unrecorded transactions, these are the transactions that remain unrecorded. Now you would find that when we are recording transactions, just to take you back a little bit for those that are doing accounting, and probably just give you a bit of some background for those that are not doing accounting but are doing our subject. Now you would now need to understand that when we are recording transactions, okay, we use what is called the concept of double entry, which would now mean that for every debit entry there is going to be a corresponding credit entry. Okay, for every account there is one that is paying and the other one that is going to be receiving. Now you would find that if this is followed closely, then it would generally entail that we must be having the amount that is being debited being equal to the amount that is being credited. Okay, but whilst this is the ideal situation, it's seldom the case that we are going to have the amount that is being debited being equal to the amount that is being credited, or the amount that is being received being equal to the probably everything else that was paid to us. Okay, now in economics now, such differences, they give rise to what is called the unrecorded transactions. In other words, our unrecorded transactions is a balancing item, is a balancing act to try and have the payments being equal to probably the receipts, or the amounts that are on the debit side being equal to the amounts that are on the credit side. So all those ones, they are just intended at probably taking note or assisting us with those transactions that we could have omitted in error because of looking at the volume of transactions that we'll be having as a country. There are high chances that we are likely going to miss on certain transactions, and then those ones, they are recorded as the unrecorded transactions. And then the last component of our balance of payment, I'll just say number 4 there, it's going to be our gold and foreign reserves. It's going to be gold and foreign reserves. Okay? Now, our gold and foreign reserves. Now, you do now need to understand that when businesses are operating in South Africa and sells its merchandise to probably an Australian company, the Australian company would expect to be paid in Australian dollars. And also, if the business is operating in South Africa and then sells the products to an Australian company, then the South African company would expect to be paid in South African rands. Whilst the Australian company that is selling goods to us, okay, they would expect to be paid in Australian dollars. Okay, now this is what we are saying. Just to clarify this, a South African company that is selling products to an Australian business, okay, would expect to be paid in South African rands, okay, right, by that Australian company. And then in Australia, if there is an Australian company probably that is selling their products maybe to Zimbabwe, it would appear that that Australian company would expect to be paid by Australian dollars. Okay? Now, when this happens, it would now mean that the companies or the companies that are buying from other companies that are outside the country, they would now need to source for the currencies. Like the South African company buying from Australia would probably need Australian dollars. Okay, and then the Australian company buying from South Africa, they would also need the South African rands. Now that gives rise to something that is called a currency. That gives rise to a currency. Now, this currency, it comes as a result of the differences that we have in the payment system. Okay? Because in South Africa we are using a rand, in Australia we are using an Australian dollar. So it would now mean that because we are using a different currency, we are going to end up having what? Issues of trying to find that particular currency so that we can be able to buy, okay, from those exporting countries. Okay? Now, I'll give you an example. You do now find that as a country, for example, we earn a lot of foreign currency when Walmart, for example, we earn a lot of currency, like close to just above $2 billion US dollars when Walmart invested in Massmart in South Africa. It injected into our economy close to 2 billion, just above 2 billion US dollars. Okay, so this is as a result of investments or foreign investors that are investing in our country. Okay, now these foreign reserves, okay, we are saying these foreign reserves normally they include things like gold. Okay, our foreign reserves are going to include things like gold. Now, foreign reserves and gold are the most important in our balance of payment. They are the most important parts of our balance of payment. Why is that so? Because they show the overall position of our balance of payment. Okay, our gold and our foreign reserves, this part of their balance of payment, it shows the overall position of our balance of payment. And not only that, they also show even the foreign reserves that are able or that are available to stabilize the rand and avoid these dramatic changes that can result in on our exchange rate. Okay, you understand? So you would also find that our foreign reserves, they play two roles. One is the most important part of our balance of payment, and then the other one is they help us to stabilize the value of the currency and avoid these dramatic fluctuations that might result from our currency against another currency. Okay, and then you would also find that the foreign reserves, including the gold, they also helps the authorities to stimulate the economy without running into financial difficulties. Okay? And then you would also understand that the last reason why foreign reserves and gold are important in our balance of payment, and why we are saying it's also the most important part of our balance of payment, is because a portion of the gold reserves is held by the South African Reserve Bank and can also be used when foreign currency is needed in our country. So when we need our foreign currency, maybe we need to buy some products, we would now need to use those foreign reserves as well as our gold as a way of trying to source products from other countries, those products that we do not have in our country. Okay, now this is balance of payment in summary. So what did we say? We said balance of payment is made up of 4 departments or 4 sub accounts. We have the current account, and we looked at what it looks at. We also have the second one, which is the financial account, and we have looked at what the financial account looks at. It also looks at the unrecorded transactions, and we have looked at what it looks at, and then it also looks at our gold and foreign reserves. So these are the balance of payment accounts that we looked at. Now, if you like the video, click the like button and remember to subscribe to the channel. All the best in your studies and good luck in the coming exams.